Hey everyone, in today's video we're going to be talking about the two cases where you have to take a required minimum distribution, otherwise known as an RMD, from your Roth accounts. Now generally we think about RMDs from our tax-deferred accounts. When we reach age 72, we're forced to take money from those given accounts due to the IRS mandates. But there are two specific cases within the IRS code that also force you to take these forced withdrawals from your Roth accounts. And so in this video, we're going to be talking about those two cases and how in some cases you can avoid taking an RMD or at the very least delay that RMD to gain the most out of your Roth accounts. And so let's jump into it. Now normally when we think about required minimum distributions, we think about required minimum distributions from our tax-deferred accounts. Again, we get a tax deduction when we contribute to our tax-deferred accounts, and we're able to defer taxes, and we have to pay those given taxes on the withdrawal. Well, the IRS knows that if we just keep deferring taxes, they're never going to get their tax liability. And so at age 72, they force you to take money from your tax-deferred accounts. Well, there are also RMDs that can come from your tax-free accounts, Roth accounts. Now, the good news with RMDs from your Roth accounts is they don't have the same tax consequence. Obviously, a Roth account withdrawal is tax-free. So even a required minimum distribution is still going to be tax-free in your situation. It's not going to push you up into a given tax hurdle. But nonetheless, taking from our Roth accounts when we otherwise would like to leave money continuing to compound and grow tax-free is less optimal for our situation. And so if we don't want to take a distribution from our Roth account, we want to make sure that we're not forced to, so that we can keep, again, growing that money tax-free. And so let's talk about the two cases where you may have a Roth RMD. Now, the first is with a Roth 401k. Now, a Roth 401k shares a lot of the same benefits that a normal, traditional 401k shares. And so a higher contribution limit, protection from creditors. Well, because of that, they have the same RMD requirement that a traditional employer-sponsored 401k would also have. So this is right from the IRS's website. What type of retirement plans require minimum distributions? The RMD rules apply to all employee-sponsored retirement plans, including profit sharing, 401k plans, 403b plans, 457 plans. And it goes on to say the RMD rules also apply to Roth 401k accounts. However, the RMD rules do not apply to Roth IRAs while the owner is alive. So Roth 401ks do have an RMD. If you have money within your Roth 401k when you reach age 72, it will have the same RMD rules as normal traditional IRAs or traditional 401ks have. This is because a Roth 401k is a company plan, an employee-sponsored plan. Roth IRAs are individual plans. That's how Roth IRAs essentially skirt the RMD rules. And so luckily, there's a very simple fix to avoid RMDs from your Roth 401k. And that simple fix is simply rolling that Roth 401k over into a Roth IRA, taking that money from an employee-sponsored plan where it will be subject to RMD rules, and rolling that over to an individual plan where there will be no RMD mandates. Now, there are a couple things that you want to keep in mind here. First, when you have money within a Roth 401k, that does not start your 5-year contribution clock for a Roth IRA. So let's say that you've had a Roth 401k for 10 years and you do not have a Roth IRA right now. Well, there is a 5-year contribution rule where when you contribute to a Roth IRA, it starts a 5-year clock. This is a once-in-a-lifetime clock that you need to start. And basically this mandates that you can't take earnings from that Roth IRA until that 5 years is over. And so rolling money from a Roth 401k to a Roth IRA would start that 5-year clock for a Roth IRA if you haven't already started it. But you can't take any earnings from that initial rollover until that 5-year clock is over. I'll link to a video up in the upper right-hand corner explaining this 5-year contribution rule a little bit more in depth. The other thing to note as well, for optimal tax protection, thinking about estate planning here, make your spouse your Roth primary beneficiary. The reason being is because, again, your spouse will not have a RMD from that Roth account. Whereas if you pass it to a non-spouse, they may have an RMD. And that leads us right into the next instance where you may have to take a required minimum distribution from a Roth account. And this is when you inherit or pass on an inheritance. And so in 2020, the Secure Act was passed and put into law. And basically the Secure Act created 3 separate classes of beneficiaries. You have your eligible designated beneficiary. This is most commonly going to be your spouse. You have your designated beneficiary. This is going to be the most common beneficiary class. And there's a 10-year rule that this class is subject to. This would be non-spouses or certain trusts if they're set up properly. And then you have a non-designated beneficiary. This would be charities, your estate, and also certain trusts. But it's important to note here that when you pass on your Roth IRA to anyone but your spouse, they will have a designated required minimum distribution that they need to take. Now again, another thing that's important to note is that if you inherited a Roth IRA pre-2020, you will have a different set of rules than if you inherited a Roth IRA after 2020. Those that inherited an IRA pre-2020 will be subject to something called the stretch rules. Again, I'll link to a video in the upper right-hand corner explaining different RMD tables and which one you are subject to if you inherited a Roth IRA prior to 2020. For those that inherited a Roth IRA after 2020 or are passing on a Roth IRA after 2020, we're going to talk about the designated beneficiary class. And again, this is most commonly a non-spouse or your children, or if you inherited an IRA from your parents. And so after the Secure Act was passed, all beneficiaries within this designated beneficiary class that have inherited a retirement account are now subject to the 10-year distribution rule. This specifies that you don't have a required minimum distribution each and every year, but you have to exhaust your entire inherited retirement account within 10 years. Now this applies to all tax-deferred accounts as well as Roth IRA accounts. And so in the same way that if you mistake an RMD, you miscalculate it from your accounts, you will also have a 50% tax penalty from missing your RMD from inherited accounts as well. And so again, you don't have a set distribution that you have to take each and every year, but by the 10th year, you have to have exhausted this entire account. Now with traditional IRAs where there's a large tax consequence from withdrawing money from these given accounts, you may want to split up and have separate, smaller withdrawals happening throughout this 10-year period. But for a Roth IRA account, because there is a tax benefit, because all of that money is growing tax-free and you're able to withdraw it all in 1 year tax-free, the most optimal way to handle RMDs from a Roth account if you don't need the money is to let it continue compounding for that entire 10-year stretch. So delay your distribution. So let's say that you inherit a $600,000 Roth IRA. If you take all of that money in year one, well, you get $600,000 and luckily it is tax-free because it's a Roth account. But if you delay that money, and let's just say earn 6% on your money for this 10-year stretch, in year 10, you're going to be able to withdraw tax-free $1,074,000 from that given account. And again, the reason you want to delay an RMD from a Roth account if you don't need the money is because you're allowing that to continue to compound tax-free. That's the exact reason why you want to make your spouse a primary beneficiary as well. If they inherit that account, they're able to compound that tax-free without an RMD. And finally, when you pass that on to the next generation, again, now they have a clock. So with Roth accounts, if we don't need the money, again, because it's a tax-free account and because the growth will compound tax-free, we want to leave that money in that account as long as possible. And so avoiding these RMDs, or at least delaying these RMDs, is pretty simple, all things considered, but make sure that you understand which accounts, specifically Roth accounts, have these given RMDs and that you're taking that RMD on that required timeline or avoiding that RMD with different strategies. Hopefully this video was informational. Always remember, you don't need more money, you need a better plan. If you like this video, please hit the like button down below. It will help other retirees just like yourself find this video and hopefully find value from this video, as well as hit the subscribe button. We release videos weekly and you'll be notified of all future videos that we release. Thanks for watching and we look forward to seeing you in the next video.